Sean Darby is global equity strategist for Jefferies. He joins us all the way from Hong Kong. Sean, good to have you back on ET Now. Thank you for joining us. Now, Asian equities have seen a sharp correction thanks to strength in the dollar index and uptick in US bond yields. After the recent price adjustment, which asset class do you think in the near term are likely to outperform for the rest of this calendar year, bonds or equities?
Well, our view is that the bond markets will probably continue to deteriorate in Asia, and I think it's due to a couple of things. One is that, as I said, we probably see interest rate cycles tightening in places like Indonesia, which will work against the bond markets. I also suspect that the higher oil prices will start to work through into some of these economies. As you've seen the fuel price subsidies being removed in Indonesia, you've also seen the gas hike prices in China being raised. So I think for the bond markets it's pretty much a difficult period for investors because we have seen record low yields. For the equity markets, I think we're in a little bit of a herder period really, because the good quality companies have not necessarily been sold off over the last quarter. So it may mean that we need to see Asian equity share prices come lower before we actually get real buying coming through. But I would expect equities to do relatively better than the bond markets in Asia.
Right, Sean, with the dollar strengthening and Fed tapering talk, do you see risks of sudden stop in capital flows in emerging markets, or at least the risk has heightened now?
We don't necessarily see any risks of a sudden shutdown of global liquidity for the emerging markets. What might happen is that a reverberation in a place, for example, like Brazil or Turkey, due to political risk, cuts issuance for a lot of the other countries, or indeed causes quite significant redemptions. But we think most of that risk will be isolated, and so far that's really what has occurred over the last couple of months.
Sean, the bad news here is that for the first time in many months, Indian equity markets have got net outflows, and for the month of June, the outflow number was pretty scary, $7 billion. Do you expect that in the near term, Indian equities will continue to experience outflows?
Well, certainly India's found itself with a double whammy. Not only has we've seen much weaker growth and redemptions, but also the currency's been weakening as well. And I think we're at the moment of a period of time now where on the policy front we're not likely to get any good news in the short term, and possibly we may get a jump in inflation expectations which might undermine the central bank. So I think India's probably one of the earlier ones to go back and buy, but probably not now in terms of absolute returns.
Sean, you've maintained that investors should paint all emerging markets with the same brush in your recent report. Which countries in Asia appear attractive to you then, and why are you so bearish when it comes to India in particular?
Well, I think India did suck in an awful lot of capital over the last 2 years. I think it's probably been early in terms of cleaning its house out, unlike China. But as I said, I don't think necessarily the good companies are priced attractively enough for people to sort of suddenly say we're getting a bargain. So I think India, as I say, is one to put on the radar screen and during bad days or bad sell-offs to go back and own. But elsewhere in the Asian markets, I would still say that Japan will tend to do a lot better. It was one of the few markets that was up in June, and also I would single out perhaps Philippines and to some extent Hong Kong.
So Sean, to your mind, what are the key risks for India going forward, and how positive is the recent correction in commodity prices for a market like India?
Certainly in terms of the price moves, there has been a very big drop in some of the agricultural prices as well as metal prices, but also energy costs remain very resilient due to the political risk in Egypt and Syria, which has raised the oil prices. So I think on a net basis it probably is neutral for India, if anything perhaps slightly negative. And as I said, with a weakening rupee, you're going to probably see some imported inflation coming through.
So do you still maintain the target of 5,300, 5,500 for the Nifty by year end?
Yes, I think we're probably going to still get a period of indigestion for emerging markets. I wouldn't be surprised if we have a couple of days where the down legs in markets seem quite extreme in relative to some of the economic numbers, and that'll be the time to go back and revisit some of these countries, particularly India.
Sean, what is your take on Indian currency going forward now?
I think there is a small chance. I think if indeed the payrolls data does start to continue to show numbers of about above 175,000 to 200,000, then the chances are the dollar's going to remain strong and the rupee will remain weaker over the next 6 to 9 months.
And when do you expect Fed to start tapering? By 2013 end or 2014 only?
Well, it's a bit of an unusual period, really. The view of Jefferies is that we probably won't see that until early next year, possibly on the very departure of Mr. Bernanke. The reason for that is that whilst we think the jobs numbers will be good, they're probably not good enough to get to around about 200,000, which would scare the markets. And the second thing we would want to highlight to people is that whilst the tapering effect will affect long-term bond yields, there's very little chance that short rates are going to move up over the next 18 to 24 months. So the Fed funds rate is anchored at a pretty low level now for the next 24 months.
Sean, so between Fed and China slowdown, which is the bigger worry for India?
I suspect it's probably the Fed move. If anything, India's relatively less exposed to the export environment, and in that respect, it's the Fed moves that would be more disruptive to the Indian financial markets.
Okay, Sean, good chatting with you. Appreciate you taking the time out and joining us on the show.